This is a recording of the February 7th, 2018 webinar from the Institute for Research on Poverty called the Tax Cuts and Jobs Act and its implications for low-income families, featuring Elaine Maag and James Ziliak. Elaine is a senior research associate at the Urban-Brookings Tax Policy Center. Before joining the Urban Institute, she worked at the IRS and the Government Accountability Office as a Presidential Management Fellow, and she has wide expertise on support programs for low-income families, specifically as they relate to the tax code. Jim is a professor of economics and director of the University of Kentucky Center for Poverty Research. His research especially focuses on tax and transfer policies and issues related to poverty policy. We thank the Office of the Assistant Secretary for Planning and Evaluation at the Department of Health and Human Services for their support of this webinar series. However, any views expressed in the webinar are those of the presenters alone and don't necessarily represent positions of ASPE or IRP. Elaine Maag is the first presenter.
Thank you. It's a real honor to be able to talk today with you about poverty and taxes. And so what I want to try to do during my portion of the webinar is convince people that tax policy significantly affects low and middle income families, and also discuss how it most recently changed with a focus on low income families, although sort of with the overview in mind that most of the action on the recent tax bill was for higher income families. So the way that tax policy affects low and middle income families most importantly is through providing credits that ultimately lift more working age people out of poverty than any other government program. So I'm going to provide some context on the types of policies that affect low income families, explain reasons why we use the tax code to differentiate among families with and without children, and ultimately show that the tax cuts passed at the end of 2017, which are in effect right now, are heavily tilted toward high-income taxpayers. The tax cuts that are for low and middle-income families are temporary. They are scheduled to expire after 2025. I don't want to linger on this a ton because as the legislation was being debated, the intent was clear that this is the tax system that policymakers would like to see going forward. There wasn't enough room in the budget to make the tax cuts permanent for the corporations and low-income families, and corporations ended up winning on that. But it's probably not too productive to dwell on what might happen in the future after 2025. So the first thing I want to talk about is there's a lot of provisions that subsidize families with children, and we do that for a variety of reasons. The first is that we generally think taxes should be based on our ability to pay. So all else equal, a larger family has less income left over to pay taxes than a smaller family. We also consider subsidizing children to be an investment in everyone's future. And third, we think that encouraging parents to work, which we can do through the tax code, ultimately benefits their children. The Tax Cuts and Jobs Act will reduce taxes by $1.5 trillion over the next decade. This is a massive amount of money. The majority of benefits will go to high-income taxpayers. And as I noted, there are moderate benefits for low and middle income families with children, and these are temporary. So there used to be 5 provisions that really affected families with children. There are 4 now. The first is the Earned Income Tax Credit. And I'm going to show a picture of each of these provisions separately so you can kind of see what they're doing, and then show them all together. But as an overview, the Earned Income Tax Credit is a refundable credit that lifts about 11 million people out of poverty each year, including many of those being children. The credit is designed to encourage work, and there's a lot of research that's been done that says it does exactly that. And it's targeted at the low end of the income distribution. The Child Tax Credit is for families with children under 17. It also lifts families out of poverty and can provide a significant benefit. I'm going to hold off on saying much more about the Child Tax Credit because that's where almost all of the action in the Tax Cut and Jobs Act was. There's also head of household filing status and what this does is it sort of differentiates a single parent from a single person who doesn't have children. There's preferential rates afforded to that single parent household, and also a larger standard deduction, so how much money you can earn before you start to owe taxes. There's also a child and dependent care tax credit intended to subsidize child care expenses. It's very small and affects a very small number of people. And then we used to have a personal exemption, which could be thought of a little bit like the head of household filing status in that there was a piece of it that it allowed you to exempt a per person amount of income. That's no longer in the tax system, and it's sort of been rolled up into that child tax credit instead. So the earned income tax credit is the big mover for low-income families. As you can see, when you start earning money, your credit rises. If you have no children, you're that bottom blue line, and your credit can be a maximum of about $500. Importantly, once you start working full-time at the minimum wage, you're already earning too much money to get much credit at all. So it's a very select group of people, very low income, usually part-year workers. Families with one child can receive a credit of about $3,500. Again, it phases in as you earn money, you earn more credit. It reaches its maximum benefit, and then you receive that maximum until the credit eventually begins to phase out. You can see on the chart for families with 2 and 3 children, the credit is even larger. This credit distributes about $60 billion in benefits annually to 26 million tax units, which are mostly families. 97% of these benefits go to families with at least one child. There were no significant changes to the EITC in the recent legislation. The one thing that changed is how fast the credit will grow in the future. So we changed the way that the whole tax system is indexed. So it's going to grow a little bit more slowly than it would absent the legislation. So the child tax credit, like I mentioned, is where the big motion was. So it's the maximum credit was doubled from $1,000 per child under 17 to $2,000 per child under 17. One oddity, though, is that while it used to be that you could receive up to $1,000 as a tax refund, so the maximum credit, now you can only receive up to $1,400 of this credit as a refund. So low-income families receive less per child than middle and high-income families. The way you calculate your credit for the refundable portion is you earn 15 cents on the dollar for every dollar you earn above $2,500, and the threshold used to be $3,000. And all that means is that low-income families who don't receive the maximum credit ultimately get about $75 more from the tax cut than they would have under the old system. Another really big change for the child tax credit is that it became not just a credit for low and middle income families, but it became a credit that extended well up the income distribution. So now the credit won't begin to phase out if you're a single parent until you have income of at least $200,000, and that's doubled if you're married. Dependents who don't qualify for this child tax credit for the under 17 can get a non-refundable credit of up to $500. And what that means is they can offset up to $500 in federal income taxes. Who are these people? They are children who don't have Social Security numbers but do have an identity number given by the IRS. They can qualify for this $500 credit. They are also children who are 17 and 18 still living at home, and college students, sort of 19 to 24, in school full-time. It's also a grandparent who might be a dependent in the household, so even though it's called the child tax credit, it now covers more than just children. It does this partly or fully for some families to offset that loss of the personal exemption. So now rather than being able to exclude about $4,000 of earnings from taxation, you get taxed on more of your earnings, but you get this $500 credit to offset those taxes. A lot of people think this is a better way to design family size adjustments because it means that a very high-income person who pays a high tax rate doesn't get a larger benefit than a middle-income person who pays a lower tax rate. So in the end, this is what the child tax credit looks like for a single parent with 2 children. It phases in, so the middle bar is what it used to look like. So it tapped out at $1,000 per child and phased out starting at about $75,000 of income. That top line is what the credit looks like for under today's law if you're under 17. So it phases in until you hit that $1,400. That's the maximum refundable portion. In this chart, it's $2,800 because there's 2 children. And then you'll start to see you owe taxes, and you start to get the non-refundable piece as well. That dashed line is the small credit, the $500 credit for those non-child dependents that don't get the $2,000 per child credit. And you can see it's non-refundable, so if you're very low income, you don't benefit at all from that. And that was true of the personal exemption as well. If you don't have income to owe taxes on, it doesn't help you to reduce the income you owe taxes on. So now the child tax credit, this chart shows how the share of the total child tax credit has shifted, and where the child tax credit used to deliver about $54 billion to 36 million families annually. It's now more than double that. It's going to distribute about $130 billion to 50 million families. But these families, unlike the EITC, which are concentrated in the bottom half of the income distribution, these families are all over. So the blue bars show who used to get the child tax credit. So it used to reach up into even that 4th income quintile with very few benefits to the highest 20% of income families. Now it's much more even. Families in the lowest income quintile get a smaller share of benefits than families at every other income quintile. Head of household filing status also changed. So the standard deduction for this group used to be $9,550, and instead it's going to jump to $18,000. This is an indexed benefit. It grows every year. That's important for people who might otherwise have itemized. There will be fewer people itemizing because it takes a much larger amount of itemized deductions, so mortgage interest, state and local taxes, charitable deductions, to get over the standard deduction threshold. The brackets are also compressed under the new tax law. So it used to be more favorable treatment for single parents, and now once you get up to about 20%, 22% bracket, your tax rate is the same whether you're single or a head of household. There's also this child and dependent care credit, and I'm just going to talk quickly about it. It phases in. It's non-refundable. That's why very low-income families don't get it. The higher bar is sort of what the law says the credit is, but in fact the credit is that lower bar because it's non-refundable, so those very low-income families don't actually receive those high credits. The credit doesn't fully phase out, though. Credit goes down to about $1,200. This, though, is a relatively small benefit. It distributes just $3.5 billion, and it almost all goes to families in the upper income distribution. So this chart is sort of what we have now. So the top bar is what the subsidy is, the difference in taxes for a single parent with 2 children versus a single person without children. And so you can see that benefits rise with income. That's that work incentive. The more you work, the more tax credits you earn. And then after the EITC and the child tax credit have finished phasing in, they sort of level off. The EITC starts to phase out, so your overall benefits decline. And then they're going to increase, and that's all because of that head of household status, so that preferential rates these families are still getting in those higher incomes. So it's a little bit of a crazy picture, but it does, in the end, show that we give, this $10,000 to $30,000 group of families is getting a little bit higher subsidy than other families, which is probably how we would want it. And there's also, it used to be a little nuttier when the personal exemption was in there too, so the tax bill made it a little more rational than it used to be. So then I did some analysis where I looked at different specific points in the income distribution to see how much lower or higher will their taxes be under the new law versus if we hadn't changed the law at all. And so the bars, the blue and yellow bars in that left half, are for a single parent with one child and a married parent with one child, and they're generally receiving higher benefits from the new law than larger families. So these are single parents with 4 children and married parents with 4 children. Benefits get larger as your income increases, except there's a few oddities, and that's what that that blue bar at the $50,000, there's some weird points in the income distribution where you actually end up owing more under the new tax law than you would have. The right side of the chart is what happens in 2027. So if the provisions actually expire, almost all families with children that are low income will owe more taxes. And that's all a product of smaller earned income tax credits because the EITC will grow more slowly now than it would have if we hadn't changed indexing. If you have families who have older children, they're basically receiving almost the same taxes under the current law as they would if we hadn't passed the legislation. Again, in 2027, they'll owe more taxes, and that's, again, because of that EITC having less favorable indexing. So the average tax change for families with children is heavily tilted towards families in the highest income quintile. So where very low income families will barely see a change in 2018, higher income families will see multi-$1,000 changes. And even if I scaled this to change in after-tax income, you would still see that larger benefits flow to higher income taxpayers. So this bill really wasn't about providing assistance to families with children or low and middle income families. By 2027, all those families with children in the first 4 income quintiles, so the bottom 80% of the income distribution, will be experiencing a slight tax increase, whereas the very highest income families with children will still see tax cuts. My final comment would just be that this was a massive shed in money. It's $1.5 trillion, and it doesn't come from nowhere, which is why I think what Jim has to speculate about is really interesting. Eventually, either taxes will rise in the future or benefit cuts will happen. And what's notable about the tax cut, although we could have designed it to massively cut taxes and increase benefits for very low-income families, we did not choose to do that in this legislation. And so we are taking, we're giving a lot of tax cuts to very high-income families, and these are unlikely to be the families that then see benefit changes on the other side of the ledger. So with that, I'll turn it over to Jim.
Thank you, Elaine. That was fantastic. And thank you all for joining us this afternoon to listen in to this webinar. So I'm going to kind of put on my economist foresight hat and say, try to look out this year and beyond as to what the implications of the Tax Cuts and Jobs Act might portend for the wider U.S. social safety net. So, the question, the title of this slide is, do tax cuts imply welfare reform? So as Elaine noted, it's estimated that the tax cut will result in a 10-year revenue loss of about $1.5 trillion. To pay for, congressional Republicans are looking to the social safety net for savings. And so I have a couple of quotes here, one from Speaker Ryan and from Wisconsin, one from Representative Bloom from Iowa. Speaker Ryan says, we're going to have to get back next year at entitlement reform, which is how you tackle the debt and the deficit. Representative Bloom said, for us to achieve 3% GDP growth over the next 10 years from tax reform, we have to have welfare reform. We need people who are mentally and physically able to work to get into the workforce. President Trump, around the time of the passage of the tax cut, seemed to support the move of Speaker Ryan and others in the House to reopen the issue of welfare reform. And so what I want to do is talk about, some of the proposals that have been put forth thus far. But before I do so, I want to, take a step back a little bit and take a broader look at the programs that are potentially on the table for reform, or at least for some changes. And I'm going to present 3 slides. The first one focuses on what I characterize as work-based transfers, because these are either available only for those in work, for example, the Earned Income Tax Credit, or the Additional Child Tax Credit. That's what the ACTC stands for. TANF has a work requirement, although there are some recipients on the TANF program who are exempt from the work requirements. And the SNAP program is a convolution of those who are not subject to work requirements as well as those who are subject to work requirements. And so this figure shows real spending. So this is an inflation-adjusted 2009 dollars. I'm using the personal consumption expenditure deflator, which is a chain-weighted deflator. And you can see that, some of these programs have trended upward over time, and then some have trended downward. So if you look at, for example, the Earned Income Tax Credit starting in 1979, is a relatively small program, $3 to $5 billion per year. But with the first significant expansion of the program with the Tax Reform Act of 1986, and then further extensions in 1990, 1993, and then again most recently in 2009 with the American Recovery and Reinvestment Act, you can see that there's strong secular growth in the Earned Income Tax Credit, so that today, in real terms, the benefits are around $60 billion. If you look at the SNAP program, which on my screen shows up as purple, and hopefully on yours as well, you can see the SNAP program is fairly cyclical. So spending goes up during recessions. You can see that little blip up with the 80, 81, 82 recession, and then there was an increase in the early 90s, and then there was a very strong increase both in response to the 2001 recession, and then again with the Great Recession of 2008 and 9, a very strong increase in the SNAP program. Importantly, though, if you look at both the SNAP and the EITC, though, they reached their peaks. The SNAP reached their peak in real spending in 2014, and there's been a pretty strong decline in the ensuing years afterwards. The most recent data are the 2017 fiscal year. And actually, you can see declines in the Earned Income Tax Credit benefit redemptions. And so both of these programs, the declines are a reflection, the EITC especially, but also SNAP is a reflection of the expanding macroeconomy that took some time to kind of gain traction, but is starting to finally kick in. And so we're seeing kind of these natural declines in spending on the programs as more people not only join work, but increase their earnings and therefore lose eligibility because of their increased earnings. If you look at the TANF program, it's split in half. It's all in black until the Welfare Reform Act of 1996, and then there's a top line in orange, which reflects total spending, and then the black line continues down. And so that highlights the cash assistance component of the TANF program. So there you can see there's been real declines in the cash part of the program. So we're down to about $8 billion in spending on the cash as of fiscal year 2015. But total spending, this includes state maintenance of effort requirement, in real terms has maintained relatively stable between $28 and $30 billion per year for overall TANF spending. The red line is the additional child tax credit. You can see that that program, there was, its inception was part of the Taxpayer Relief Act of 1997. And so it took a couple of years for it to kind of ramp up, and then the benefits were expanded a little bit in the tax cut of 2001. And so you can see there's been pretty strong growth in the additional child tax credit, which, Elaine highlighted is going to grow considerably under the new Tax Act that was passed in December. And then, okay, so that's it for that slide. So you can see that, in terms of work-based transfers, the TANF program, at least the cash component, has been declining for nearly 2 decades since the welfare reform. Overall spending has been basically constant. The SNAP program had strong growth during the first decade of the 2000s, but is now kind of coming back down as the economy gets stronger. The same is true with the EITC. Okay, the next I have is trends in disability, health, and retirement benefits. Again, these are in 2009 inflation-adjusted dollars using the personal consumption expenditure deflator, the same deflator as before. So the lowest line is the supplemental security income program, and so this is disability benefits for the aged, poor, the blind, and the disabled. A key distinction between SSI and SSDI, which is Social Security Disability Insurance, is that SSI does not require any prior work history for eligibility, whereas SSDI does require a work history component. So you can see that there's been some upward growth in real spending on SSI to the tune today that we're spending a little over between $40 and $50 billion on the SSI program. SSDI, you can see, is now close to about $100 billion in inflation-adjusted spending overall. There was a pretty strong secular growth in that program starting in the 1990s. It is important to note that there has not been major kind of fundamental changes to the structure of those programs. The SSI program, there was a Supreme Court decision, the Ziliak back in 1990, that changed eligibility provisions for children to align them with the appropriate activities that children were expected to hold, as opposed to adhering to the more stringent work type tests that adults were subject to. But other than that, there were some changes to the SSI as part of the welfare reform, but nothing, and that was more in the order of restricting access than expanding access. And so there what we're seeing is that there's, some of the growth is from the Zebli decision, some has been from some transition from the former AFDC and TANF programs onto SSI amongst children. The SSDI program has not had any major change in structure since 1983. So there what we're seeing is a couple of factors of demographic aging, as well as just the sheer fact that there are more people eligible with the rising labor force participation, especially amongst women in the 1970s through the 1980s. There were just more people potentially in the labor force and therefore potentially eligible for the disability insurance program. In terms of acceptance rates on the programs, they've actually been fairly stable over time, so there's not been any dramatic change. So there we're seeing kind of a steady secular growth, although you will note that as of 2012, inflation-adjusted spending on DI has stabilized, and in fact, in the most recent year of 2016 has actually started to turn down. The orange line is Medicaid spending, which is health insurance for the aged poor, as well as children and other low-income families. And there you can see pretty strong secular growth. In inflation-adjusted terms, we're spending over $500 billion a year. On Medicaid, you can see kind of a strong increase after the introduction of the Affordable Care Act. Above that is the Medicare program, and then finally the Social Security program. And the Social Security part is just the retirement benefits component. I've stripped out the disability insurance as well as the survivors. So this is just the retirement component. And there with both Medicare and Social Security, you are seeing strong secular growth in the program. In inflation-adjusted terms, they're about equal-sized, a little over $600 billion in real spending for each program in 2016. Medicare, there was an expansion of benefits in terms of the introduction of the prescription drug benefit in 2004. But mostly what we're seeing there is a combination of cost inflation for the provision of health care, as well as secular aging, demographic aging. With the Social Security program, the last kind of major change in benefit structure, again, was back in the early 1980s. And so, again, this is mostly a reflection of demographic aging. And then you can see kind of the strong increase around the Great Recession of 2008. And this is reflecting actually the retirement age of the baby boom cohort. All right, so this next figure kind of tries to put into perspective just four of the programs, so not to totally confuse you with too many lines, but to take the programs and put them as a fraction of gross domestic product, which is a kind of our overall measure of the size of the economy. And so I'm showing you the Earned Income Tax Credit and the Supplemental Nutrition Assistance Program, Medicaid, and Medicare. And there you can see that as a fraction of the overall economy, both the EITC and SNAP account for less than 0.5% of GDP as a whole. And you can see that both programs have declined since 2013 as a share of the economy. And again, this is a reflection of the fact that people are moving off the program and spending is falling while the macroeconomy is growing. And so the programs are kind of operating the way that they were designed, as this automatic stabilizer to assist people in times of need. But then when they don't need the assistance any longer, they move off the program. In terms of Medicaid and Medicare, you can see again secular growth in the program. Of course, you also pick up some cyclical components, and that's more from the denominator moving than the numerator moving. Okay, so you're picking up recessionary eras in those figures, as well as with the EITC and SNAP as well. But today, Social Security, Medicare is accounting for about 3.5% of GDP, and Medicaid as a whole about 3%. Social Security is on the same order as Medicare, which is also about 3.5%. So Medicare and Social Security retirement benefits combined are a little over 7% of GDP. If you add in Medicaid, then it brings us over just over 10%. Okay, so that gives us a little bit of economic backdrop. So as the Congress weighs how to potentially pay for this $1.5 trillion in tax cuts, many members in both the House and Senate have pointed to the safety net as a potential area for reform and possible savings to shore up the reduction in tax collections. So some of the proposals, and this is not a comprehensive list, and you know, we can talk more during the Q&A part about some alternatives, but I wanted to highlight a few kind of common themes. So the common theme that's come out of many of the proposals, especially out of the House, is towards greater decentralization. And by this I mean decentralization from federal provision down to the state level. So, for example, block grants have been proposed both for the SNAP and the Medicaid program. And as a reminder, the Aid to Families with Dependent Children program was a matching grant program funded using the same formula as currently operates for the Medicaid program. And with the 1996 welfare reform and the creation of the TANF program in place of AFDC, states now receive a fixed block grant that was based on the size of their AFDC caseload in the 92 to 94 fiscal years. That block grant has been held fixed in nominal terms. The total aggregate amount was $16.5 billion. Once you adjust for inflation, that's fallen by about 40% in real terms over time since the reform 21 years ago. So there's been proposals to do the same with SNAP. Currently, SNAP, the actual benefits are fully federally funded. States have to pay 1/2 of the administrative costs, and the federal government picks up the other half of the administrative costs. So there have been proposals to block grant the SNAP program, much like TANF. Likewise, as I mentioned, the Medicaid program is a matching grant, and the matching grant works that low-income states contribute a smaller share of spending towards Medicaid relative to the federal share. So in a state like Kentucky, where I live, the state pays about 30% of Medicaid, and the federal government picks up about 70%. In California, a higher income state, is closer to a 50-50 share. So that's the way the matching grant works. But there have been proposals to block grant Medicaid down to the state level. And if such a decentralization in the form of block grants takes place, some of these proposals would allow states to design the SNAP program and the Medicaid program more flexibly than is current policy, and there is some concern amongst some people in the research and policy communities that they may be modeled too much after TANF, and I'll come back to that momentarily. There has also been proposals to convert the SNAP program into a matching grant, kind of similar in structure to what we have for the Medicaid program. And in fact, this was part of President Trump's 2018 budget. And the proposal in the president's budget was to gradually roll out state contribution toward the provision of benefits. So as I mentioned, currently the federal government picks up all the benefit costs of the SNAP program, and the president's proposal would be by 2025 that states would be responsible for 25% of the benefit cost. So it would be moving benefit provision to the states. And so some concern is that states would, faced with that extra fiscal strain, would be forced to constrict eligibility for the SNAP program. There is also, within the entitlement system, been proposals over the years for privatization or perhaps partial privatization. So in Speaker Ryan's proposal a couple years ago entitled A Better Way, he talked at length about a privatization option of the Medicare program, where consumers would have the option of receiving vouchers to buy insurance from the private market rather than participating in the federally funded and sponsored Medicare program. And likewise, there have been proposals over the years. The most recent kind of systematic proposal was under President Bush back in 2005 to do privatization, or at least partial privatization of the Social Security program. These are kind of the big, what I would call big fundamental reform proposals that have been put out over the last couple of years through various members of the Congress. However, in the interim, there's kind of a wave towards what I might call incremental reform. And we're seeing this most prominently in the expansion of work requirements. So, for example, there's a proposal in the House from Representative Jordan from Ohio, and in the Senate from Senator Lee from Utah. For example, would increase the work requirement amongst the ABOWs. These are the able-bodied adults without dependents who are between the ages of 18 and 49. Currently, ABOWs are required to work 20 hours or more per week in order to qualify for SNAP benefits. If they don't meet that 20-hour per week work requirement, then they are only eligible for SNAP in 3 months out of any 3-year period. The ABOWD waiver was waived during the Great Recession, but it's now back in place throughout the country, although there are some states that have waivers. So states have had the ability to request waivers from the ABOWD provision since their introduction as part of the 1996 welfare reform. And so there are still some counties and states with the ABOWD waiver provision. But the Lee and Jordan bill would increase that work requirement to 25 hours per week from the current 20 hours per week. There's also part of that bill to increase that work requirement to SNAP cases with dependent children. Currently, there is no work requirement if you have dependent children or dependents of any age in the household. And so there would be an introduction of that work requirement to SNAP households, and I think their age, if I recall correctly, their age cutoff would be 6 and older. So if the children are under age 6, they would be exempt from the work requirement. There is, I also mentioned the introduction of ABOWs in the Medicaid program. The state of Kentucky, where I'm at, recently received approval on its waiver to the Medicaid program, and starting July 1 of this year, there will be a work requirement for these ABOWs in the Medicaid program. The state of Kentucky has actually expanded the definition of ABOWD vis-a-vis the SNAP program. Under SNAP, as I mentioned, it's 18 to 49-year-olds. The Kentucky Medicaid waiver applies to 19 to 64-year-olds, where you will be required to have a work requirement. And there is also provisions in that waiver. There's a loss of dental coverage, and so by participating in various activities, for example, volunteer service and things like that, these ABOWs could earn points to regain access to, for example, dental care coverage over time. So there are other states, Indiana, and there are others with requests to introduce these work requirements in the Medicaid program. There's also increased pressure for more frequent recertification for program eligibility. So an example of that is in the Medicaid waiver that Kentucky received, there will be monthly recertification required for these ABOWs. So that will increase the administrative costs quite significantly for both the state as well as for the potential participants in the Medicaid program. And finally, there's the incremental reform that can occur through restricted growth. And so, how do we restrict growth? Well, one example is seen through the TANF block grant. When the block grant was established, as I mentioned, it was set at a nominal dollar amount. It was not indexed to inflation, and so the real value of TANF has declined substantially. And so one way that the safety net savings can occur through the safety net is to restrict growth. And so Elaine actually pointed out, one way that savings will occur through the EITC program is by using a more conservative measure of inflation for indexing, so that the size of the credit amount doesn't grow as fast as under prior tax law. What is a little bit of some of the evidence base for this? And then I'll stop and we can turn it over to questions here. Much of our evidence base draws from our experience on TANF. The block grant to states, offered a lot of discretion to design their programs. I wrote a survey on the recent research on the the TANF program that came out in 2016. And there are other excellent surveys earlier by Robert Moffitt and Rebecca Blank and others who have written on the experience of the TANF program. And I think there are, one takeaway, especially with the recent push towards work requirements, there have been some claims that, the evidence suggests that work requirements lead to self-sufficiency, but the research just doesn't back that claim up. If you look closely at the research on the TANF program, that work requirements did have some role in accounting for the decline in participation in AFDC during the waiver era, and then TANF after its introduction. There is some evidence that the work requirements did lead to some higher employment amongst the former welfare recipients. But there's a little effect on overall incomes, and in fact, amongst the most vulnerable, if anything, the evidence points towards decline in incomes, and that's because of the clawback of their transfer benefits outweighed their increase in earnings that they got from the labor market. The other thing, and this is, Elaine highlighted this a couple of times, and this is one thing you see manifest in the TANF block grant, is that target efficiency has declined dramatically. And so under the old AFDC program, about 75 out of every 100 children living in poverty received assistance on AFDC. Today, under TANF, that fraction is now just over 20 out of every 100 children living in poverty. So the program today, because most of the emphasis is on the non-assistance and not the cash program, states have a lot of leeway on eligibility, and over time the eligibility has kind of moved up the income distribution. And so much like we're seeing some of the tax changes, for example, the expansion of the child tax credit eligibility to married couples with up to $400,000, that we're losing kind of the target efficiency towards lower and middle income families. And so I think this is one thing to bear in mind as we move forward towards the reform debates in the wider social safety net.